if you think about what's Roku's advantage in the industry, well, we're the leading streaming platform, what does that mean? Well, it means, television used to be just sort of broadcast and it would just show up on your TV. Now you've got a computer in your living room. Of course, we make it simple and it looks like TV, but that power of that computer that's in your TV now allows a lot of features that weren't available before.
Welcome back, everyone, to the Audacious Money Witch channel, where we talk about stocks and investing and trading and a lot of fun things. Forget Netflix stock, heavily debt loaded. Why Roku stock is still an undervalued hidden gem. Last Halloween, I recommended Roku stock as a generational buy in the $50 as I bought my shares in the company, saying continued improvement in underlying business metrics and a dirt cheap value. It has paid off so far. In this video, I will give you my reason why I sold my Netflix stock at that time to buy Roku stock, and why it's still an undervalued hidden gem. So let's just jump straight into this rabbit hole. How the streaming ecosystem, the advertising ecosystem for connected TV, is highly efficient compared to what we currently see in the linear TV space. If you have 50 million households and you're broadcasting the Super Bowl, all of those households typically see the same advertisements. What we're going to see created in the streaming space is something that's more similar to what you're used to on social media, meaning that all of your advertisements are personalized given the first-party data that these companies like Roku are able to collect. So you're going to see a highly efficient market evolve around the connected TV space, something that linear has never and will never be able to match, just given the way that the content is broadcast to their viewers.
Hey Roku, where's the remote?
Turn on movie mode.
Starting in March, Roku will design and build its own TVs. What? By adding TVs to its rapidly growing smart home product lineup, Roku is taking charge of its own destiny, reducing its dependence on OEM partners like TCL and Hisense. The timing of this move is off-putting due to the capital-intensive nature of this business. However, Roku is building a powerful ecosystem of hardware and software to serve as a walled garden for selling ads. With its net cash balance of $2 billion plus, Roku could easily afford to invest aggressively during this economic downturn. The long-term outlook for Roku remains bright.
If you just look at the streaming platform business, our main competitors are Google and Amazon. We've been competing with them for a long time, very successfully. And the reason is we're just incredibly focused on the streaming platform business. We built a platform purpose-built for streaming, whereas our competitors have taken a platform designed for mobile and ported it to streaming. We built something from the ground up for streaming, and that's enabled us to become the #1 streaming platform with, like I said, 71 million active accounts, adding 10 million active accounts last year, growing globally. So it's a competitive business, but we are extremely well positioned.
As the shift in ad spending from linear TV to connected TV is only a matter of when, not if. And hence, ignoring near-term macro pressures is of critical importance for investors. At around 2x value platform revenue, Roku is dirt cheap, and long-term investors buying it at $56 could potentially generate CAGR return of about 33% over the next 5 years. Over the last 12 months, Roku stock has risen by nearly around 70%. In investing, being contrarian and right is what drives market-beating performance, and I am pleased to see Roku getting much deserved love by Mr. Market. While the ascent was quite bumpy, Roku finished 2023 with a stunning gain after announcing various cost-cutting measures in October. Despite persistent macroeconomic uncertainty, the ad market outlook for 2024, a U.S. presidential election year, is improving. And given Roku's strong subscriber count growth, a recovery in connected TV ad spending could very well accelerate Roku's journey to sustain profitability. Roku is also in the ad business like Meta. It's better than what you think. With soft landing becoming the view on Wall Street, digital ad spending has rebounded and market projections have gotten stronger. In early December 2023, agency holding companies like Dentsu released its advertising forecasts, calling for plus 4% to plus 7% year-over-year growth in global ad spending in 2024. While the macroeconomic environment remains uncertain, cooling inflation, improving business sentiment, and the U.S. presidential election are likely to boost the ad market. Now, the TV streaming connected TV ad market. Roku's TAM is expected to be the fast-growing digital advertising channel, with various agency projections indicating a double-digit growth rate. According to eMarketer, CTV ad spending in the U.S. will increase by plus 22.3% from $24.6 billion in 2023 to $30.1 billion in 2024, accounting for all growth in ad spending across TV, linear, and connected streaming. Other agencies like Dentsu and BIA have forecasted even stronger growth in CTV ad spending at plus 30.8% and plus 39.5% respectively. According to Dentsu, major video platforms like Netflix, Amazon, Disney, launching or refining their ad offering are set to reshape the CTV advertising channel. Transformation in connected TV advertising market. Executives at every major streaming giant with both an ad-supported and an ad-free tier, including Disney, Netflix, Paramount, Warner Brothers, Discovery, and NBC Universal, say that total revenue per user is high on the ad-supported plan than it is on the ad-free plan. Not only do media companies generate more revenue per user with an ad-supported option, but the potential for growth is much greater. Ultimately, there's a limit to how much viewers will spend on subscriptions. Economic pressures on the consumer right now are increasing the appeal of a free or low-cost option. That is supported by ads. However, this model is only sustainable if the ad load is significantly lower than traditional linear TV. And the only way we get there is if the ads are relevant to the viewer, so that advertisers are willing to pay more for each of them. It's why we work closely with the world's streaming services to fully realize the value of that exchange. As the #1 TV streaming platform in the US, Mexico, and Canada, Roku is a natural beneficiary of growth in the connected TV ad market, given its rich first-party data, unique insights into viewers. In Q3 2023, Roku reported platform revenue growth of plus 18% year over year, driven by strength in content distribution and video advertising. While Roku's management prudently urged caution due to economic uncertainties and uneven recovery in the ad market, robust account growth over the last several years can pay off big time in 2024. If the CTV ad market were to register rapid double-digit growth as the ad agency forecasted, Roku forecast for 2024. According to analysts' estimates, Roku is set to grow revenues by around 12% to $3.84 billion in 2024. Woo! Ted, do you go on Facebook more or do you watch TV? Oh, you watch TV more? And you eat popcorn. Yes, we know that. He always talks about how he loves popcorn. Over the last couple of years, Roku has been subsidizing its hardware, selling devices at a loss to keep growing its ecosystem, user base. In my view, Roku's strategy is to build a walled garden akin to Apple, but for TVs and smart home devices. For a long-term perspective, I think Roku is doing the right thing by growing its user base as fast as possible, even if that means losses in the near to medium term.
Great F.
As for analyst estimates, Roku is posed to cut its losses by more than half this year. However, Roku is expected to remain unprofitable for the next 3 years. Is Roku stock a buy or a sell? Let me know your comment in the comment section below what you think. Despite an impending growth reacceleration and margin expansion, Roku's trades at significant discount to digital advertising giants like Meta Platforms and Google. While Roku's lower margin profile and current growth rates somewhat justify the discounted relative valuation, this gap is likely to be bridged in 2024 as Roku's year-over-year revenue growth reaccelerates back to the 20 to 30% range. 20 to 30% range, woo! And margins expand on revenue mix shift towards higher margin platform revenues. As a greater share of TV ad spending, a $90 billion market, shifts to streaming connected TV in the US, Roku is primed to experience secular growth for several more years to come, with the company boasting higher than 30% market share of TV OS aggregator platforms in its US market. While its international expansion is still in the baby stages, I think Roku's strong performance in Mexico and Canada speaks volumes for long-term growth potential. In the long run, I see the global TV OS market consolidating into 2 to 3 players, similar to what we have seen with the mobile OS and PC desktop OS markets. And given Roku's current market-leading position and powerful flywheel, I think it is primed to be a top player in this attractive arena. $100 billion plus advertising TAM. Woo! By the end of this decade, I view Roku as a $30 to $40 billion annual ad revenue business, 200 to 250 million active accounts globally, and ARPU of around $150, while net losses could stay elevated for the next couple of quarters. Roku's underlying business trends have shown strong positive momentum, and the business is set to turn free cash flow generative in 2024. The near-term macroeconomic ad market outlook remains uncertain. However, Roku's long-term future looks brighter than ever. Based on price-to-sale ratio, balance sheet, and shareholders' equity comparison with other tech companies, like gross margin, Roku is higher than Netflix. Balance sheet, much better than Netflix with no debt. Revenue growth, much higher than Netflix. Roku is worth $150 per share. It is still trading at a significant discount to that fair value. I would rate Roku as a buy today. Let me know in the comment section what you think. If you are interested, but personally, I would not buy right now when the market just made a new all-time high.